Recording in progress.
Hi, good evening, everyone. Thank you for joining in the call. Today on the call, we have our fixed income team, which is headed by Parijat Agarwal. And we also have two fund managers, Anandyo and Devesh. Along with that, we also have our CEO, Mr. G. Pradeep Kumar, on the call. Once again, thank you for joining in the call. Without taking much time, today's agenda is talking about the monetary policy and the way forward. Over to you, Parijat.
Thank you, Saurabh. I'll share the this PPT. Just hold on.
Yeah.
Is it visible, Saurabh?
Yes, it is visible. Can you put it on the slideshow mode, please?
Yeah, I'm doing it. Taking little slow. So, yeah. So thank you, Saurabh, and good evening, friends. So today we had the much anticipated monetary policy after the budget, which was really looked up by the bond market players. So the monetary policy in their wisdom have kept the policy repo rate unchanged, and also decided to keep the reverse repo rate unchanged at 3.35. So repo rate remains unchanged at 4%. Reverse repo rate remains unchanged at 3.35, and MSF rate and bank rate remains unchanged at 4.25. Also, the stance remains accommodative as long as necessary to revive the growth. So, complete status quo. And if we read through the various statements from the governor and the press conference, it is a very dovish policy which has come out. Markets were expecting that there could be some signal to start normalizing the policy by hiking the reverse repo rate from 335 to 3.5, or maybe by 40 basis to 375. But MPC have decided to continue with status quo on the rates, as well as accommodative stance on the policy stance, and to remain accommodative as long as necessary to sustain the growth. Now, further key points to understand in this policy is that what was the decision behind making this policy remain unchanged status quo, both on the rates as well as on the stance. First and foremost, the inflation data, which RBI, the MPC has projected, they believe that for the first quarter, for the last quarter of this financial year, it would be somewhere around 5.7. But for the next financial year, the inflation could head towards lower band of their policy target, which is that at 4%, which is the target rate. So for the full year of next financial year, the MPC has projected inflation to be at 4.5%, which is expected to trend downwards from Q4 of this financial year, which is expected at 5.7 for this Q4 of this financial year. And then from Q1 of next financial year, it is expected to trend from 4.9% onwards to 4.2%, taking the full year at 4.5%. This is a very substantial outcome which has come from the MPC because this very clearly highlights that the risks are not that high, which markets had factored in for the inflation, looking at the inflation data from the overseas, the global central banks, and which we have seen at other geographies, which we have seen at running at close to a decadal high in the developed economies. So that's a very dovish outcome which we have seen. from the MPC. The second factor which kept the policy rate unchanged and stands competitive is obviously growth. The MPC believes that the growth still needs policy support because it's not broad-based and it would continue to remain uneven in the coming quarters. So they believe that for the full year it is the projected at 7.8%, and in the Q1 at 17.2%, then it starts heading downwards at 4.45% for the last quarter of the next financial year. So obviously, in this policy, the MPC has put large part of the emphasis on sustaining growth. And this has come on the back of their analysis that inflation would remain benign at their target zone of 4%. So that's what made this policy very, very dovish. And in fact, for the liquidity also, they have mentioned there would be sufficient liquidity to sustain the growth, and the liquidity normalization also would be very, very gradual. And in fact, any normalization which the governor has highlighted would be very gradual, well telegraphed, and well guided. So, a large part of markets' anxiety has been taken away by today's policy, and the outlook for the next financial year on inflation and growth numbers. If you look at this chart, which gives the details about where is the liquidity in the domestic system, looking at this chart will show you that it continues to remain at elevated levels. It is still, the negative numbers means the system is surplus with liquidity. So if you look at the liquidity is shown by the green chart. The green chart still shows upwards of the 6.5 lakh crores is the systemic liquidity which is in the domestic system, which is still very large. And RBI has hinted that this liquidity normalization or taking out liquidity would be by way of 14-day VRRR. That is, they will continue to do 14-day VRRR, that is variable rate reverse repo operation, which would coincide with the CRR dates, that fortnightly with CRR. And similarly, they will do VRR, that is, variable rate repo, also on the fortnightly basis, that 14-day cycle. So in order to, infuse liquidity in case if they see that there is, a tightening happening. So that is how RBI intends to manage the liquidity going forward. So this has been done in order to smoothen the process of liquidity management going forward. So in fact, the VRRR operations has already, taken up the overnight rates on average weighted basis to 3.87%. This is what the governor highlighted. And another reason for keeping the reverse repo rate unchanged at 3.35 was in order to, telegraph the RBI stance of continue to support the financial markets. That's what is meant by this measure of keeping the reverse repo rate at 3.35. If we look at the 10-year GSEC, which is there in this chart, so obviously it is just a week back we have seen that 10-year had moved up to 6.95, which was at around 6.75 by the month end. But with the high gross borrowing by the government of India, it actually jumped by 20 basis points. However, today's dovish policy, comforting statements by the MPC and RBI governor, it has retraced back that 20 basis points which it had moved up. So it is back to 6.72% levels as of close today. So this 1 week of volatility is back to normal. Another thing to highlight is that the statements coming from the MPC and the RBI and their projections for the next financial year for inflation and growth has hinted that any policy normalization would be a very gradual one, not very steep, well telegraphed, and for the next at least two policies, that MPC which would meet on in today's February is April and again is June. The markets are expecting that there would not be any substantial hike even on the reverse repo rate. So RBI would continue to manage the liquidity by using this variable rate reverse repo operations. So because of that, markets on the shorter end up to 5 years fell by 20 basis points. So today with this policy, we saw the short end that up to 5 year substantial down move in the yields by 20 basis points. And then on the long end, which is a 10 year, we saw that yields falling by 7 to 8 basis points. So that's how the yield curve has moved after the policy. And if you look at this chart, which is again, we have given the credit deposit growth rate YOY, but here today we have taken a weekly YOY. If you see this chart, there has been some uptick in the credit uptick, the growth rate, but again it is started to fall. So we are seeing these numbers again remaining the deposit growth remains closer to 10%, and your credit growth remains around 7%. So there is still a gap of 3%. That is supposed to keep the systemic liquidity excess in the domestic system. So, and there has been some early signs of recovery because that is being visible by the slight uptick in credit growth. But again, it is somewhere started to stall. Though there has been some improvement, but not substantial. That could also be one reason we believe that MPC chose to maintain status quo on rates as well as on distance. This is a very, very interesting and important chart which I'm sharing with you. This is our in-house what we call is a high frequency leading indicator, which is made up of our 29 variables. And if you look at this chart, before the pre-COVID level, the HFLI was at around 36 percentile. And today we are somewhere around 21 percentile. So still we have not reached. So this chart, very, very clearly highlights the concerns of the MPC in terms of the growth numbers. So in order to, bring back the growth or to sustain the growth on a durable basis, the MPC chose and to continue with accommodative stance and status bond rates. If you see from the September onwards, our HFLI shows that some uptick, but again it has started to stall, and some downtrend is visible on that. So from this chart, it appears that policy support for growth would continue for a longer period than what market was anticipating. Markets were thinking that the policy normalization would start sooner. There could be some guideline or some direction from MPC of how soon it would be normalized. But looking at this chart is once again very clearly visible that the policy support for growth would remain much longer than what the market is anticipating or it had anticipated. Now, in the policy also, there was a lot of discussion on, as I discussed about the inflation, which RBI has predicted about 4.5%. So RBI governor highlighted that there could be spillovers from the global spillovers, from the policy normalization and tighter monetary policy for the developed economies that we have seen. The US Fed has already hinted that they are on the path of tighter monetary policy and could hike the policy rate by 3 times in this financial year, this financial year. So that's one policy that global spillovers, which could be keep the domestic bond yields volatile. And there are some headwinds coming from the higher commodity prices, specifically for the oil, because that's a large part we import. So that could again keep the policy rates to keep at lower rates a challenging part, and it could continue to put pressure on the domestic inflation. However, when we were listening to the RBI governor's press conference, it was asked that how can we be so certain that could be at 4.5%, and looking at oil prices and other factors, the global factors, it would remain so low. In response, the RBI governor said that they have looked at all angles, both negative as well as positive, to arrive at this number, and they have done detailed analysis. So, in fact, he also said, when we are giving this number, it is, we are putting our credibility at stake, RBI's credibility, that, we believe that it would be at 4.5%. So, obviously, they have factored in at a higher level of oil in their calculations. And also, they believe that, going forward, the supply side issues would start, coming down, and that would keep the policy, the inflation at a much lower rate than what markets are looking at it. And in fact, it is, if you look at the US markets or developed economies also, there also, the inflation is starting to peak out. That also could be one factor which they must have built in their calculations or projections for the next financial year. So now looking at this, we believe that, as we have seen today, the spread between the curve has steepened by 10 basis points between 5 to 10 years, because 5 years and below rallied by almost 16 basis points, and the 10 year has rallied by only 7 to 8 basis points. So it has again steepened by close to 8 to 10 basis points. So looking at today's scenario, it appears that short term would remain benign. There could be demand for the short term papers, but however, the 10 to 14 year bucket could remain under pressure, because a large part of the borrowing happens in that segment. So obviously, when the government borrowing is large, it is expansionary, it would remain under pressure. So that steepness would remain, at least in the near term, till we get some clarity how RBI is going to support the large Government of India borrowing. As highlighted, the fiscal deficit target for next financial year is 6.4. A large borrowing program is there. One thing to note here is, if you read through the borrowing program of Government of India, every year, which again was highlighted by RBI governor, that every year NHI used to borrow close to 70,000 crores from the market. This year, this borrowing is built in the fiscal deficit number, that is gross borrowing of Government of India. So basically, NHI is expected not to hit the market for borrowing, but it would be largely from the budgetary support, which is built in the Government of India. Another point which was highlighted was that close to 25 to 30,000 crores, which the BSNL borrows from the market, is again built in the gross borrowing of the Government of India. So in a nutshell, he was saying that, or trying to say that, they are going to support the Government of India's borrowing program, and that should keep the longer end yields capped, in the sense that the spike which we had seen in the last week would not be so violent, but yes, it would be a gradual up move because of the borrowing program. The uncertainty around the growth and inflation would continue, and Governor also emphasized that the ongoing catching up of activity, specifically of the private consumption, still below the pre-pandemic level. So that's one very big factor which he highlighted that needs policy support for a durable and broad-based recovery. So that again is showing, and that what the was shown by the market reaction today with the yields coming down. That at least RBI would continue to support the financial markets. And looking forward in the near to medium term, we believe that rates would remain benign. Benign doesn't mean that rates are going to fall substantially. What we mean here is that the kind of volatility and uptick which we saw in the past, 1.5 months, looks little far away, and it would remain in a range bound with gradual uptick in the rates as we move forward, and as the growth starts coming in, policy is normalized, and as we see that liquidity is withdrawn from the domestic system. So any uptick in the bond yields would be gradual, unless there is some global spillovers, as I highlighted earlier. Otherwise, it's expected to remain range bound, at least in the near term. So from looking at that, a fund which has a 2-year duration, like corporate bond fund, is would be a beneficiary of this policy. That's what, in a nutshell, I have to say about the policy, and going forward, how we see it's going to shape up. So, as I mentioned, corporate bond fund is the best suited product and structure for our investors. So, thank you. I'll hand it over to Pradeep for his comments.
Yeah, thank you, Parijat. I think that's been a very, very comprehensive view of what's been happening in the fixed income markets, not just the Monetary Policy Committee, but developments over the last few weeks, which has caught most players by surprise by the extent of the volatility. So it's good to have that bit of calm again in the market. So thank you for all the insights, and I really have nothing much to add, and we can take questions.
Thank you, Pradeep. The first question, Pari, is whether increasing limit for FPIs help when we see the underutilization of the existing limits already.
See, to answer this question, the increase in the limit is an enabler. Now, it is very difficult to say that the limit is unutilized today. Now, it depends on various factors. So tomorrow, when the growth starts picking up and we have some consolidation on the fiscal side, or revenues are picking up, there could interest may come in, because if the inflation pans out the way it has been projected, investors would start looking at the kind of returns the Indian markets are offering, and then start visualizing that what kind of inflation dynamics would play out in the developed economies. So one has to be prepared with these numbers rather than doing ad hoc. So I would say that's a good strategy to increase the limit, even if it is unutilized as of now. It can get utilized, and people may demand more tomorrow. So I would say that is a good step from the RBI.
The second question is, do we agree with Governor on his statement denying being behind the curve and being on the right path by not following global central banks' movement blindly?
I would say that whatever RBI Governor has said is correct. If you look at the statements of Deputy Governor Pathrak, because they believe that the drivers of inflation and growth in our economy is very, very different from the drivers of growth and economy in, say, US or Europe. So, for example, the inflation is running very high in US markets, in the US economy, because their drivers are different. So there the food inflation is very high. The percentage in CPI is small. Food inflation in our economy is not that high. We had a bumper rabi crop and crop, and it is close to 2 to 3%, but the weightage is close to 50%. So the main driver for our, for the inflation is much different from theirs, and ours is a large rural economy. So drivers of growth comes from there also. So that's what he highlighted, that if we simply blindly follow what the US economy or their Fed is doing, that would not be in would be supporting the domestic growth or domestic economy, which is the need of the hour. So I would say that from that angle, if you really look deeper, I would say that RBI has done the right thing by trying to support the economy by going little slow, and when things really heat up, they still have sufficient tools to hike the rates or to do more.
Do we also think that being the last quarter, they prefer to be dovish, and the next policy is in the next financial year, and they may change their stance over there? So the idea is not to tinker in this financial year, look at next financial year. Can that be the reason for being dovish?
I wouldn't read like that way. So there can be various interpretations for that, but I wouldn't read like that way. Why? If you I had shown one chart of HFLI, high frequency leading indicator, where we said that pre-pandemic level was at 36 percentile. Today we're still at 21. Now, when an economy is trying to struggle and grow, because we have seen and we are all aware how the economy got shattered, specifically our SMEs and MSMEs. So in such a scenario, we have not even reached the pre-pandemic levels, which the developed economy, some of them have already reached. Then tighten the rates, start normalizing aggressively is not the need of the hour, rather to support the economy. So I think that could be the major factor which made them more dovish. And in terms of the inflation, yes, they have said that they have taken all factors into consideration before arriving at, because that's been a major part or factor for policy to be so dovish is 4.5 inflation, not staying accommodative, or the stance being, or the rates not being changed. It is more about the inflation numbers which they have come out with. So they have done their homework. This is what RBI governor kept on highlighting. So looking at their analysis, we need to believe them. Yes, there could be some. At the end of the day, it is projection. But the idea is to be nearer to that rather than being far away from that. So from that angle, I would say I wouldn't read the way people are reading it.
Thanks, Hari. The next question is on taxation. As an indirect taxation system, the GST is already taxing the expenditure on all goods and service. How expenditure-based taxation is different from GST?
See, it is a very wide topic to say that, for all expenditures, because the GST itself means that every expense is taxed. So, I'm not able to understand the exact question. So, when we came out from various, rates, because it becomes a uniform taxation structure, that's what the GST is. So, I would say that, that was the, 2 years back we started doing this, the GST. So that was the idea. So that, uniform taxation across the country. So we have, that has started showing results in higher collection. So I think, taxing the expenditure, it is, inbuilt a part of the GST. So it is not different from there. So the idea is to tax at each point wherever the value is getting added. So that's what it is.
Thanks, Hari. The next question is, how is the liquidity excess or deficit calculated?
Anindya, would you like to take this question?
I know you're on mute.
Yeah.
Yeah. Can you repeat the question?
How
What
is
is
the liquidity? How is the liquidity, whether it is excess or deficit, calculated?
Okay, there are various factors, various variables that goes in the liquidity that is in surplus or in deficit. I believe what we are trying to understand is what are the drivers of liquidity surplus?
Yeah. When we say that market has got so much of liquidity, how is that figure calculated? I think that's a question.
Yeah. So it is basically we get a LAF number, liquidity adjust. This is a repo, reverse repo, that tells us how much excess amount that is surplus and is not being utilized. So that is deployed at certain rate with RBI. That gives an indication. That's one of the key components of liquidity in the system. The LAF figures. But where does this liquidity come from? It comes from the market operations of RBI, and also the how the exchange rate fluctuates, and the inflows and outflows from the external world. So the primary component of the liquidity surplus or in deficit can be gauged from the LAF figures.
I would add to that. This liquidity is measured. This comes from, we can check it from RBI's daily operations. It is in LAF, then regular operations like VRR, and then TLTRO. All those operations add to liquidity, and that gives a clear picture whether it's deficient or surplus liquidity in the system. That we can get it from RBI website also.
Thanks, Avish.
On daily basis.
Yeah. Thanks. Pai, the next question is, when government is looking to borrow heavily in the coming financial year, as announced in the budget, how will a dovish stance help government borrow? Will people be, buying bonds at a lower level, additional bonds for the coming year?
See, these are not very highly correlated that, if there's a high, if the policy remains dovish, so people will buy bonds. When there is a large borrowing, definitely yes, there is a pressure because the buyers are limited. Buyers are only our banks, insurance and mutual funds largely. So now, obviously, when you borrow more, the yields have to go up. This is, as clear as it is that. However, by remaining dovish, it is not a question of dovish. It is the path which RBI had given that rates would be very, very well calibrated if any change in the policy. So when markets get comfort that, they know that, even if there is large borrowing, so what kind of volatility or how much, the yields can go up or it can go down. So based on that and their own internal requirements, I will look at opportunities where I can make money. Suppose today there is no credit uptick. Then by looking at RBI's policy, the statements, I can invest very clearly in government bonds because I am clear that where I can make more money. Is there possibility of losing more or getting more? So that's how the policy statements, help the government to borrow.
What is the strategy on the dynamic bond fund given the policy now going forward? Are we looking to go long? We're looking to
yes, that's a very valid question. See, as Pradeep highlighted, last week volatility, lot of people say, got surprised. Lot of buying, selling happened. Obviously, but going forward, what it appears is that there is a point on the curve where even if there is some uptick in the yields going forward, you will still get substantial benefit from the accrual. So maybe 5-year paper, 6-year paper, or 7-year paper, and avoiding volatility. So going forward, at least in the near to medium term, investing a large part on this part of the curve is definitely going to help the dynamic bond fund. So right now we are at 1.98. So moving back to say 3.5, 4 would definitely help the fund to do much better than rather than staying at a very short end and staying in cash. So because the accrual will outperform the your any uptick on the yields in the near term.
Thanks, Pari. There's a follow-up question on this. One of the investor had invested into a dynamic bond fund 18 months back, and the money was for 3 years. Now, due to the interest rate risk in the future, should we switch to corporate bond fund or remain invested in dynamic bond fund?
See, if he had asked me 1 week back, I would have said, please switch, sir. But today, after reading MPC, hearing the statement of both governor and deputy governor, I would advise stay put, sir.
Okay. There are a couple of questions on equity, which I'll take it. The one question is that what is the estimated fair value growth of CAGR for the next 5 years? So our view on equity is that markets are trading at a premium. Typically, if you look at a large cap, the fair value grow at 12% approximately. But right now we are at a premium. So the next 5 year CAGR will be somewhere high single digit for the next 5 years, which is what the valuations are looking like on the large cap side. So that's on the fair value. In terms of, there's one question of which is the top fund in the AMC. So we don't have a concept of the top fund or the best fund or whatever people call the name. So our oldest fund is the flexi cap fund. Given the current market conditions, where we expect equity markets to be on the slightly at a premium, on the equity side, we are recommending people to come into allocation products like BAF, hybrid equity, etc. And if they're looking at equity products, pure equity products, they can do STPs into the flexi cap fund. And if you look at the performance of all our equity funds, they are consistently doing extremely well over a long period. In terms of debt, clearly when you heard Paiza talking about the debt, for the fresh money corporate bond fund and even dynamic bond fund for the period of 18 months and above makes sense. Am I right, Pari, over here?
Yes, you are right.
So there are two funds on the debt side, and there's a similar question that what is the right fund for 2 to 3 years on the debt market? I think you can safely come into a corporate bond fund if your horizon is more than 2 years.
That's correct.
Just let me go through the. Yeah, so this was all the questions. Thank you once again for joining in the call.
Thank you.
Thank you.
Thank you.
Thank you.
Recording stopped.